In this video, I'm going to show you why index fund investing, but more specifically S&P 500 index fund investing, is the easiest and arguably the best way to invest your money in the stock market. The best part about S&P 500 index fund investing is that you don't have to be a stock market expert, you don't have to have any trading experience, and you don't need to check your account balance every single day. All you need to do is have a brokerage account like a Robinhood or a TD Ameritrade, and you are well on your way to successful investing in the stock market with a well-diversified portfolio. There are so many people that I talk to that want to start investing in the stock market, but they just don't know where to get started. And they ask me things like, hey Ravi, should I buy Apple? Should I buy Microsoft? Or should I buy Facebook? Or should I buy Tesla? And you know what I tell them? I tell them to buy an S&P 500 index fund and contribute to it every single month for as long as you can. Because with an S&P 500 index fund, you're buying Apple, you're buying Microsoft and Facebook, as well as 497 other companies with one simple transaction that takes you less than 20 seconds to do. And S&P 500 index funds have been endorsed by some of the greatest and best investors in the world, including Warren Buffett. In fact, just a few weeks ago at Berkshire Hathaway's annual shareholder meeting, Warren Buffett said that when he passes away, he's leaving his money to his wife, of which 90% of it will be put in an S&P 500 index fund. In fact, the bulk of my own retirement portfolio is in an S&P 500 index fund. And speaking of retirement and wealth creation, I want to get one thing off of my chest. I'm not saying that an S&P 500 index fund is the best way to invest your money. There are other funds out there that have performed better, and there are a lot of funds out there that have performed worse, including some notable hedge funds that charge a lot of money in fees to their clients. The main reason for me making this video is for you, the viewer, and to inspire you all to start investing. I don't care if you hire a financial advisor, I don't care if you use a robo-advisor, I don't care if you're investing in index funds or in mutual funds. If you're not even invested in the stock market through a well-diversified instrument, you're already committing a big mistake in doing yourself and your future a disservice. Literally, the hardest part of investing is getting started, and I'm hoping that this video will inspire you to get started. At this point, you probably have a lot of questions like, what's an index fund? Which S&P 500 index fund should I invest in? How do I even buy an S&P 500 index fund? And how long do I need to invest for? Well, don't worry, because in this video, I'm going to answer all of these questions plus more. And just to reiterate, I'm not benefiting from this video in any way at all. I made it with the genuine intention of helping everyday people out and help them create a better future for themselves. But if you could do me a quick favor and hit that like and subscribe button, it would be greatly appreciated. To understand what an S&P 500 index fund is, we need to understand what the S&P 500 is. The S&P 500 is an index comprised of the 500 largest companies in America, and it's considered to be the benchmark standard to gauge the performance of how the stock market is performing as a whole. When we go to a website like Yahoo Finance or when we watch the evening news, we are usually shown stock market performance, and the host will usually mention the Dow Jones, the Nasdaq, and the S&P 500. All three of these are stock market indexes, and they are all made up of a variety of different companies. In the case of the S&P 500, it's made up of the 500 largest companies in the United States based on their overall value, aka their market cap. If we take a brief look at the 500 companies that make up the S&P 500, you can see that Apple tops the list, followed by Microsoft, Amazon, Alphabet, Tesla, etc. That's because the S&P 500 is a market capitalization weighted index, so bigger companies make up a larger proportion of the index. As an example, you'll see that as of today, Apple makes up the largest proportion of the index at 5.81%, and Disney, as an example, makes up 0.95% of the index. That's because Apple is currently worth roughly $2.1 trillion and is the most valuable company in the world, and Disney is worth $325 billion. The cool thing about the S&P 500 index is that the order and makeup of these companies is always changing. For instance, if Apple stock drops 20% over the next 12 months, it will no longer be the biggest holding in the index. While I was doing research for this video, I found the top 20 holdings in the S&P 500 from September 15th, 2008. And as you can see, the top 20 companies in the S&P 500 look very different from the top 20 companies in the S&P 500 today, aside from good old Microsoft maintaining its position. Okay, so now that you know what the S&P 500 is and how its composition is created, now let's talk about what an S&P 500 index fund is. Put simply, an S&P 500 index fund is a fund that you and I can invest in that literally mimics the S&P 500 index. So for example, if we put $1,000 in an S&P 500 index fund today, 5.81% of that $1,000 would go to Apple, 5.33% of it would go to Microsoft, and 4.16% of it would go to Amazon, so on and so forth. And if the S&P 500 goes up 2% on a Wednesday, your S&P index fund will go up 2% on Wednesday as well. And if the S&P 500 goes down a half a percentage point next Tuesday, your index fund will do the same thing. Index funds are intentionally created to be directly correlated to the index that they track. The funny thing is that indexes like the S&P 500 were created as a benchmark, as a way for fund managers and mutual fund managers to rate their performance. So if the S&P 500 returns 7% on any given year and a mutual fund returned 9% during that same year, you would say that the mutual fund outperformed the market or its benchmark. Now the thing is that when you or I or anyone else on this planet gives a financial advisor or a hedge fund or a mutual fund our money, we pay them with the intention that they will outperform the S&P 500 or whatever their respective benchmark is. This is called active investing, and the purpose of active investing is that some bigwig, probably with an Ivy League degree, is charging you big money in the form of fees to outperform the S&P 500. Now don't get me wrong, some mutual funds and hedge funds do outperform the S&P 500, but over half of them don't on any given year, and that's why an S&P 500 index fund is the way to go for a large majority of the population, including myself. That leads me to the next portion of this video, which is what S&P 500 index fund should you invest in? Now I personally invest in the Vanguard S&P 500 ETF, which trades under ticker symbol VOO. And if we head over to the fund's homepage on the Vanguard website, we can read the product summary and more details on the fund. Here it clearly states that the fund invests in stocks in the S&P 500 index, representing the 500 largest US companies, and its goal is to closely track the index's return, which is considered a gauge of overall US stock returns. Now the cool thing about VOO is that it's an ETF, so it literally trades like a stock. That means that you can buy it at any time during normal trading hours, and unlike its corresponding mutual fund, it doesn't require a $3,000 account minimum. And the best thing about this ETF is its expense ratio, and that's essentially the annual fee that you'll be paying to hold this ETF. For VOO, the expense ratio is 0.03%, which in the world of investing is extremely, extremely, extremely low. That means that if I were to invest $10,000 into this fund today, my annual account fees would only be $3 over the course of the year. That's right, you would only pay $3 to Vanguard to manage a $10,000 portfolio. And the reason that they're able to keep the fees so low is because this is a passively managed investment vehicle. Computers and algorithms are doing a bulk of the work in the background while you go about enjoying your day. And remember when I said this fund directly tracks the S&P 500? Just take a look at the 1 year, 3 year, 5 year, and 10 year annual returns of Vanguard's S&P 500 index fund versus the actual S&P 500 index. You will see that their performance is virtually identical, with the fund averaging 14.14% returns over the past 10 years versus 14.17% for the index. Over the past 10 years, the fund has averaged 14.17% in returns, which is quite remarkable, but it's also due to the fact that we are in a 10+ year bull market. But even if we go back 100 years, the S&P 500 has still returned an average of about 8% per year. And with the power of compounding, let me show you some examples of what an 8% annual return means in the real world. Now let's assume that you are 30 years old and you put $5,000 as an initial investment into an S&P 500 index fund like VOO, and you contribute $400 to it every single month. Assuming that you'll retire when you're 65 years old, that means that you have a 35-year investment time span. So with your initial deposit and your monthly contributions, the principal or the amount that you would have allocated to this fund would be $173,000 over 35 years. Now, if you didn't invest your money in an S&P 500 index fund or invest your money at all, you'd have $173,000 35 years from now. But if you listen to me and put your money into a Vanguard S&P 500 index fund, your money would have grown to over $1 million over that same 35-year investment time span. And this example is assuming that you only have a 35-year investment time span. If you're 25 years old, you can add 5 years to this compound interest calculator, and you'll see that your investment would be worth over $1.5 million by the time you retire by only making one simple investment. That's why when I talk to people, especially young people, I try to explain to them that time is on their side. The sooner you start investing in the stock market, the better off you will be in the long run. And this is a simple investment strategy that literally anyone can initiate. You can do it for yourself, you can do it for your parents, and most importantly, you can do it for your young children. I know this video is a little bit longer than my normal videos, but I wanted to give you all a thorough understanding of what an S&P 500 index fund is. Now, it's important to understand that every investment, whether it's a stock investment or a real estate investment or a business investment, they all have some sort of underlying risk. And no one on this planet knows what's going to happen to the S&P 500 over the next 20 to 30 years. But if the last 100 years are any indication of what's possible with this one simple investment, I'd say the S&P 500 index fund is a pretty good bet. And with that, ladies and gentlemen, I'm going to call it a video. Thank you all for watching, and please remember to like this video and subscribe to my YouTube channel for more content like this. I'll see you all next time.